Good afternoon. Thank you for joining us for the Duke Credit Union Home Buying Seminar. My name is Jennifer Sider. I'll be assisting our presenters today. Please note the seminar is being recorded. Please drop off if you would not like to participate. All participants will be muted without video other than the presenters. We will answer questions as time allows at the end of the presentation. Please submit your questions via the chat function at your screen and reply to everyone so that questions can be seen by everyone. If we do not have time to answer your question, we'll list an email address at the end of the presentation where you can email us your questions. I'd like to turn the meeting over to our presenter, Keisha Hill, Mortgage Loan Officer. Thank you, Keisha.
Thanks, Jennifer. Good afternoon, everyone, and welcome to Duke University Federal Credit Union's webinar for home buying. Whether you are a first-time home buyer or this is your second, third, fourth, fifth turnaround, we welcome you to listen to the information that we have to present to you today, and particularly of some of the programs that we offer here at the credit union and just the processes. As each year turns, new regulations, new guidelines, sort of make this situation a little bit more of a challenge, but our goal today is to really give you enough information, or at least the start of information, to help you guide through this process. Before we get started, would love to introduce the mortgage team here at Duke Credit Union. Myself first, but certainly Donna Adams. So I'm Keisha Hill. I'm the mortgage lending counselor here. I'm one of the mortgage loan officers here that helps with mortgages. I've been doing mortgages for about 17 years and 24 years in banking, lending experience. Donna Adams is our loan officer here as well.
Hello, everyone. I am Donna Adams. I am a loan officer in the mortgage lending department. I have been with Duke Credit Union for 20 years. I just want to say thank you for joining the session, and we have some really great information to pass on.
Thanks, Donna. So we're going to go ahead and get started with the next slide. Thanks, Jennifer. Certainly want to do a lot of disclaimers and disclosures to letting you know that Duke Federal Credit Union is an equal housing lender. And so any information that is obtained during the mortgage process is data information that we are required to hand in, but it does not have any leverage in regards to whether or not you will receive or obtain a mortgage. It is just to make sure that we are adhering and to the fair lending practices and guidelines that is set forth through the federal regulations. Next page, please. So to get started, just to give a general idea of what the market is looking like. I know everyone is hearing news about mortgage rates at all-time low. Everything is great. But I will say that this tends to be what we call a seller's market, simply because individuals who are selling their home are selling them at very premium and high prices. But these are the prices for the mortgage or the area. And so on the next couple of slides, I will be kind of showing you what the average is. As you can see, for the entire triangle region, the on average is roughly 300,000 as of December 2019. And then that actually went up to about 338,000 on average in the entire triangle region. But Duke Federal Credit Union, we do lend for primary residences, not only in the triangle region that accounts for Durham County, Wake County, Chapel Hill, and the surrounding areas, but anywhere in the state of North Carolina. So please, by all means, if you're looking to purchase a home in North Carolina, Duke Credit Union may be the option for you, okay? Next slide, please. So we're gonna get started with the 6 steps of home ownership. And these 6 steps are basically the standard 6 steps. Some lenders may say 5, 4, 10, but we're trying to make it as simple as possible so that everyone can sort of get an idea of what is expected. Many years ago, for those who have purchased before, you pretty much just went to a realtor and told them that you were interested in purchasing a home. Now things are a little bit more streamlined, and that's just simply because they want to make sure that you are ready to move forward to the next steps, especially since a lot of regulatory guidelines have changed in the process. So the 6 steps will include, and we'll look at each of these in detail, is examining your finances. Of course, we want to know and make sure you are able to move forward with the home that you're interested in, and making sure that it is affordable for you, as well as qualifying for the loan that you're applying for. Step 2, determining that right mortgage, again, is going to do that same thing. Step 3 is we're going to introduce to you all the home purchase partners. Of course, we're from the lending aspect, but we'll talk about the other partners that are involved in the process as well. Step 4, home buying timeline, so that you can get a realistic idea of what we are experiencing today in this mortgage process timeline world. Step 5 is the pre-closing matters, anything that is not only handled at closing, but right before. And the last, of course, is your closing date and post-closing. Again, we've put everyone on mute, and if you do have any questions at any point of this presentation, please do not hesitate to put your questions in the chat box, and we will address those questions at the end of the presentation. Next slide, please. So the first step, examining your finances. The key is knowing what your budget. We normally challenge our members to just get started with writing their budget. We typically will ask you questions such as, what do you feel is a comfortable mortgage payment for you? Because mortgage payments are slightly different than your rent payment. Some rents include utilities, some do not. Whereas mortgages are broken down into 4 and sometimes 6 components and pieces. So we try to ask the member, what is your ideal comfortable mortgage payment? And also, what's the price range? Certainly just kind of having an idea, even if you've never visited or gone on site or looked online or drove in a neighborhood, just kind of getting an idea of that price range that you feel is attracting your interest. Because ultimately, we want you to enjoy the home that you are purchasing. The second thing is the credit score and credit history. We would recommend that you pull your own credit report and credit score. We do have a free access to your credit score. The federal government has approved annualcreditreport.com, which allows individuals to obtain a copy of their credit report and a score from that as well, at least once a year, every 12 months, from any one of the 3 credit bureaus. And you can actually pull from any one of the 3 or all 3 if you'd like from the annual credit report. And that sort of gives you an idea, 1, to make sure that everything that's reporting is accurate. And then 2, to make sure that if it's not accurate or it needs updating, such as you've made a payment or paid off an item or you've closed an item that is not appearing to, certainly being able to get those items corrected. We have found out that 1 in 4 credit reports will have some formal error on them, whether that be a minor error or a major error, such as someone else's information is attached to your credit report. So it's always good to get a copy for yourself. And then you would hear individuals or lenders talk about obtaining a pre-qualification or pre-approval. There are 2 differences between them. With the pre-qualification, that's pretty much more of a manual calculation that a lender can provide for you in determining the loan program that you may be eligible for, the purchase price of the loan that you may be eligible for, and then just kind of give you a general cost estimate so that you can kind of see something in physical form. Now, I do say that that type of process of pre-qualification is about 75% accurate because, again, it is done from a manual perspective that we do from the lending perspective. In regards to a pre-approval is you actually submitting in an application. Even if you have not found a property that you are interested in putting an offer in, A pre-approval still will allow you to submit an application in without property or address. And it's just basically a hard inquiry to your credit. And it gives us a window to be able to see exactly what is reporting. And it allows us to pull a tri-merge credit report with all three credit bureaus from Equifax, Experian, and TransUnion. Now, from a lending perspective in mortgages, we look at the middle score. So with the three credit bureaus being pulled, we look at the middle score. And if it is a joint application with two borrowers, a borrower and a co-borrower, for example, we look at the middle score of each borrower and go with the lowest score with the person or the borrower that has the lowest score between the two. And that's just the way that the lending industry is currently when it comes up to mortgages and qualification. But what a pre-approval does is it makes us look at your information in real time. We're looking at actual information that's being reported. We look at that in determining your credit, in determining the loan program, in determining the amount of the loan program, and then we're able to kind of give you the next steps towards it. So depending on which one works better for you, you could certainly select that option. A pre-approval is still about 85% accurate. I don't count anything 100% until we're physically sitting at the closing table. And that's just simply because there is a lot of behind the scenes regulatory guidelines in which your file will have to receive what is called a full review, full documentation, and full process. And then the third thing is looking at your savings and your funds available. Take inventory of the available funds that you have to put towards the down payment, the closing costs, and any reserves that are required. Currently, Duke Credit Union, we do not offer 100% financing. For first-time home buyers, we do allow as little as 3% to put down for your purchase. With other members who may have owned before, or let's say you're upgrading or downgrading to a smaller home, whichever your preference is, and you have an existing home, you can put as little as 5% down, okay? But take inventory of the funds that you have available, because you would have to at least have that 3 to 5% to put towards your down payment. And then you have some additional fees such as your closing costs, prepaids, and reserves. And we'll talk a little bit more about that. Next slide, please. So you definitely want to determine the right mortgage. Here at Duke Federal Credit Union, we have the opportunity to service not only our employees here at Duke themselves, but their family members or anyone that is within our membership qualification criteria. And certainly we would love to assist all of our prospective buyers. However, we do also want to encourage you to obtain information from 2 to 3 lenders to compare. Large financial institutions is another good option. Sometimes you have your banking relationship with some of the larger institutions, such as Bank of America, Wells Fargo, BB&T, SunTrust. But certainly it's always good to get their point of view as well in perspective of your qualification criteria. And then I've also seen individuals get information from mortgage brokerage companies, such as Quicken Loans, Rocket Mortgage, places such as that, that you're more than welcome to get your qualifications from that as well. And then if you're looking to build a home, sometimes these builders or local builders, large builders, have builder in-housing lending. And so they too may be able to give you a pre-qualification or a pre-approval in relation to how much you would be eligible for. So today we're going to learn a little bit more about the loan programs that we offer. Here at the credit union, we offer conventional mortgages through Fannie Mae. You may hear individuals say Fannie Mae, Freddie Mac, Jenny Mac, that sort of thing. We offer it through Fannie Mae. I call Fannie and Freddie sister and brother. Their guidelines are within the same window for federal regulations, but we offer it through Fannie Mae. We also offer the Federal Housing Administration, or FHA is what you would commonly hear individuals refer to. We also offer loans through that program as well. Currently, we do not offer loans through the Federal Affairs or United States Department of Agriculture, which is your USDA loans. Honestly, we don't get a lot of increase on that, but it's something that we, certainly can look into in the near future, and the possibility of being able to offer in that as well. And then specialty loan programs. We do offer some specialty loan programs. However, they do have a little bit more stringent guidelines and qualification criteria, but certainly those individuals who may normally either fit through a conventional or an FHA program, but may have one item that may be slightly off. If it's within our, fair lending guidelines, we can certainly look at a specialty loan program option for you. Let's go to the next slide, please. So this is where I was referencing in regards to the multiple factors in a mortgage payment. The components of a mortgage payment consist of PITI, which is known as the principal amount, which is based on the actual loan amount that you had obtained, the interest that's going to accrue on that principal amount, taxes, which is the property taxes for the property that you're purchasing, and insurance is your homeowner's insurance. And that's basically, you would get a homeowner's insurance policy to cover your home in the event of an incident or situation in regards to the home. So those are the major 4 components, which is the PITI. But there could also be additional components such as private mortgage insurance, or PMI is what you would hear out in the world. PMI comes into play if you're not putting 20% down. Back in the 80s, people had to put 20% down, otherwise they pretty much could not get a loan. What private mortgage insurance, or PMI, has allowed us to be able to do is to get this additional insurance that covers in the event that you were to default, but it also helps you, the borrower, to be able to still purchase a home, but put less down. So you can certainly put your 3% or your 5%, but just note that you will have this additional mortgage insurance coverage on there until you reach your 20% of equity in the home to where it would fall off. Now, we'll say on the conventional mortgages through Fannie Mae, PMI does go away. And it's when you have that 20% put down, or whether you have 20% fully invested into the home. Whereas on FHA, it not only has one, but it has 2 MIs. It has a upfront MI and it has a monthly. It's still a great program because it will help individuals who may not see themselves qualify under the conventional Fannie Mae program, but potentially qualify under the FHA program. Because again, the FHA program is a government-backed program, but that PMI is on that loan twice, okay? And it does not go away. At this point, it does not go away for the, after the 20% is invested. It is essentially for the life of the loan. And then you have homeowners insurance, homeowners association dues, known as HOA dues. Now, if you are in some type of development, planned development, subdivision, yes, a homeowner dues are there, such as for condos, townhomes, and even single family homes that are in subdivisions or planned developments. And so that normally is a separate payment because you'll pay it directly to that homeowners association. However, we still have to calculate it as a part of your total monthly mortgage payment to make sure that you're within qualifiable range. Okay, so just keep that in mind as well, that in addition to the PITI, and if private mortgage is applicable, that we may also have to calculate and estimate what that homeowners association will do to your overall payment and picture. Our mortgage loan programs and plans are 30-year fixed, 20-year fixed, 15-year fixed, and 10-year fixed. particularly for the conventional loan program. For FHA, currently we just have a 30-year fix and a 15-year fix for FHA. And as we discussed before, your down payments can be anywhere between 3 to 5%, depending upon your loan program and your criteria as a first-time home buyer versus a previous homeowner. Next slide, please. So the next step we talked about, which is the home purchase partners. Our home purchase partners not only just involve us as loan officers, but it also involves your real estate agent. And as a buyer, real estate agents are there to assist you with the process of putting in your offer, making your negotiations, and finding that home that you feel is right for you. And the neat thing from a buyer's perspective, a real estate agent is not at a cost to you. It is a cost to the seller. So the seller actually pays for your real estate agent out of their loan proceeds at the end of your closing. But an agent can be a great tool and asset, particularly an individual who is very familiar with the area in which you're looking to purchase a home. Another partner is your attorney. Your attorneys, your real estate attorneys will conduct the closing and prepare the closing documents. And they also will do the title review and title search and work closely with the title company. And that's just to make sure that there is a smooth, legal documented transmission from the property from the previous owners and any other entities that may have an attachment to that home from a lien perspective over to you as the new homeowner. The other partner is an appraiser. From the lending standpoint, we would require an appraiser to go out and appraise the property. And so the appraiser's goal is to just make sure that the house that you're purchasing is based off the market area that it's in, that it is at least at the value of your sales contract, okay? If the value is higher, of course, they will notate that. If the value is lower, they will also notate that. And normally what we would recommend is that if it is lower than your sales purchase price, you would want to maybe reach out to your agent as well as to the seller to talk about the possibility of renegotiating the sales price of your home. And the reason behind that is because we qualify your mortgage based off of the purchase price or the sales price, whichever is the lesser of the two. So if you opt for a property that actually appraised less than what the purchase price is, please understand that that means that you will have to make up the shortfall in the funds that you have to put towards the purchase of that home. And then, of course, we have some partners that you do not see and that are not on this call today. And that's our underwriters and our processors. They work behind the scenes and they work as diligently and as quickly as possible. And they probably process anywhere between 50 to 100 loans in the back end. But they are there to make sure that we do fair lending, as well as make sure that your loan program and your loan process is in adherence to the regulatory guidelines. And so they're just people that's in the back that you will not have contact with at all. But certainly I want to let you know that they will make sure that your loan is processed and kept within the regulatory guidelines. And then the last but not least is home inspectors and pest inspectors. From a lender's perspective, we don't require a home inspection or a pest inspection, but it's strongly recommended by the real estate agent and for you exactly. And the reason being is just simply because from a lender's perspective, we want to make sure that the home is valued and we get that information from the appraiser. What you, the borrower, would like to make sure is that everything works in the home as it is, as well as kind of learn some of the lifelines on certain things, such as your water heater. They can tell you This is a new water heater. It should last on this average lifespan, your roof, things of that nature. Also letting you know that your electrical sockets are all functional, or if you may have some electrical issues. It kind of gives you a little bit more in detail, a picture of what the home that you're purchasing, what it's going to look like. And so you definitely would want to get that, because the appraisal is not going to go that much into detail. Now, an appraiser may say, this house looks a little bit slightly unbalanced, and may ask for a structural inspector, or suggest a structural inspector or a home inspection. And then is at that point that then the lender will require or suggest that we do a home inspection before we can move further. And then, of course, you also want to make sure that you don't have any pests, either be termites or any rodents that might have seeped their way through the home. Next slide, please. The home buying timeline. So the first step in this day and age is for you to obtain either the pre-qualification or pre-approval process. Most lenders, most realtors, what we're getting back from realtors is that they will want to know when a person comes to them wanting to see homes, that that person is ready to move to that next step, because this next step can go pretty fast. And so they now are referring or requiring that borrowers go through and make sure that they have been either pre-qualified or pre-approved with their loan, so that they know whether or not they're ready, okay? Once they have that and you have a pre-qualification or a pre-approval letter, you will take that to the realtor and they will assist you in searching for your home. Once you find the home that's right for you, their goal or their objective is to negotiate it and put it under contract, okay? Now, I will say this, the pre-qualification, pre-process, and the search for your home, while you're doing that, that's the time to really do not only your search for your home, but also get those cost estimates from the 1 to 2 or 3 lenders that you're thinking between. That's the time to shop for your mortgage as well. But when you get under contract, the clock starts ticking. Most contracts are written for 30 days. And with all those partners on the previous slide that I spoke with you about, every partner is diligently working, trying to get their portion of that process, of your process, complete within those 30 days. So it's critically important that you do not wait when you sign the contract to start shopping for your lender. You would already want to know pretty much which lenders you're interested in and which one you're going to decide to go with, because that's the lender that's going to need to obtain a copy of that sales contract, as well as some additional documentations to get your mortgage application moved into process, into underwriting, okay? And so that's where you would see a submission of a full application at that point. Now, the submission of an application process just by itself, that process in underwriting could take at least 20 of those 30 days. And so that's why it is key. Every document that you are requested to provide is looked through with the fine-tooth comb, and they looking for full documentation and full disclosure. And so that's why it takes as long as it does within that process. Once you come out of underwriting, there's 2 phases to the underwriting, and in some cases 3 phases to the underwriting. So the goal, at least here at Duke Federal Credit Union, is to obtain as much as your documentation up front from our members, so that we don't have that back and forth constantly. Otherwise, it can only delay your process. So when a lender requests documents from a borrower, I strongly recommend that you provide it to them. Now, a lender may ask you to provide documentations on more than one occasions. 1 or 2 things is possibly happening. 1, what you've provided may not have been sufficient, or 2, we've had some new recently regulatory guidelines that have been updated, and it is requiring us to ask, particularly for pay stubs, statements, more than once because they want to make sure that you are within a qualified mortgage criteria, as well as you show the ability to repay. And so now more than ever, just simply because of the day and times that we're living in, some documentation needs to be verified more than the first time that you submitted the documentation in. And then the closing disclosure and loan closing. The closing disclosure is the document that you want to see because that means that you have pretty much completed the underwriting process. You will be given two closing disclosures. One will be called a preliminary closing disclosure, and that's usually given to you within 24 hours from the time that you have cleared to close for your loan from out of underwriting process. That's just going to have the outline of what your fees look like so far. And then the more formal final closing disclosure is issued to you 24 hours before your actual closing date. And so that's what we reference, the two difference between the preliminary and the final closing disclosure. Next slide, please. Pre-closing matters. This is that 6 to 10 days. So 20 days, as I stated, on average is what underwriting process is. Your closing can be 6 to 10 days before closing date. And the reason being is because, again, you have so many entities that are involved in the process. And what the goal is to make sure that now that your file has come out of underwriting, it's sort of like a compliance, second look, third look review on the closing matters. So again, you would receive what is called a clear to close. You will receive that preliminary closing disclosures, just kind of outlining a summary of everything after the underwriting has been completed. Typically during these time, your realtor would set up time for you to walk through, do a final walkthrough through the home or property that you're purchasing. And this is also the time for you to prepare your funds for closing. Now, one thing I forgot to mention earlier, your bulk of your closing costs and funds will be required at the end. However, you would have paid some things ahead of time. You would have had to, on your contract, on your sales contract, you would have had to put down money called earnest money. And in some cases, in most cases, what we're seeing lately, particularly in the Triangle area, you would have to put down what is called due diligence monies. And so funds for that is paid up front. And so that's why it's key when a lender provides you with a pre-qualification and a pre-approval, they want to make sure before giving you that letter that you have the sufficient funds to close for the entire process, because you're going to have to give monies throughout the process and even up to closing date and time. But at this part of the process, we're taking a final inventory and making sure what your final figure will be that you will have to bring. And so any funds that had been contributed before will get credited to. Now, the only funds that will not get credited to this would be funds that you may have paid for home inspections and pest inspections, because those are not required. But any money that has been put down for due diligence, earnest money, if you put your money down for the appraisal up front as well, and any additional monies that you were asked to put down on the contract in addition to, those things will be then credited as you've already given them. And then the difference of what's remaining will be what we would disclose to you that will be needed at the time of closing. So you would want to prepare that. Attorneys, closing attorneys and title companies are getting away from accepting certified checks. They're more and prevalent to do wires. So the key thing is that if you're having to do a wire for your closing costs, you definitely want to make sure that you have those funds readily available and that you touch bases with your financial institution that you have your primary account relationship with that's holding the funds for your closing, you want to make sure that you meet within their timeline on when they can conduct that wire for you. Because at the time of closing, the attorney is going to want their funds right there front and center. Otherwise, you will not close and you will not receive the keys to the property. And then, of course, we talked about the final issuance of the closing disclosure. Post-closing items really are, do you have the electricity connected? Do you have, if you're having anything delivered, when is your delivery date, things of that nature, that you can certainly, prepare a few days ahead, but not too many days ahead, as you want to make sure that everything is connected, at least by the time you move into the property, but not too much time before you move into the property and close. Okay. Next slide, please. So I thought to include just kind of an example copy of a closing cost estimate here for you. And one of the reasons is this is what you would be requesting from those lenders that you're shopping. This is an example copy of what we issue here at Duke Credit Union. And it just kind of breaks it down a little bit so that you can get a realistic picture of what it looks like. So this example is the cost estimate 30-year conventional. Purchase price is $250. This person was putting 3% down, so they're a first-time home buyer. And their loan amount would be $242,500. Their 30-year fixed conventional, and their interest rate based off of this was 3.25. You will also see to the right-hand side of that number an APR, which is your annual percentage rate. And that's listed as 3.811. Why is there a difference? Because the interest rate is daily compounded based off of your principal balance that's owed. And the APR is looking at what your total cost would be over the life of this loan. So if you just made your regular monthly payment, no late pays, no slow pays, you didn't make any extra payments to your mortgage, in that 30-year time, this would be the total amount of principal that you would have paid out in relationship to the interest that accrued over that 30 years of principal, and the fees associated for your closing. And so that's why that APR is a little higher, because realistically, that's what you can estimate that you will pay out for this life of this loan. Now, how you can get that APR lower is either putting more monies down at the time of purchase, or making extra principal only payments to get the principal down, because your interest is accrued based off of the principal, okay? Or paying it off or refinancing it is another way, of course. But just keeping in mind, when lenders are quoting you rates, determining, is this the interest rate or is this the APR? Sometimes lenders cannot give you an exact APR because they don't have all the factors to look at the total 30 years. But again, if you are getting 2 or 3 quotes from lenders, they should at least be able to give you an estimate similar to this. From Duke Credit Union's perspective, we try to be upfront and total transparent with our members. So we outline all the fees that could be potentially associated with it. So where you see the summary of charges are your closing costs in essence. And this just kind of outlines what could be the total fees for this loan as far as the closing costs are concerned. Anything that says title beside it is really handled by the closing attorney and your title company. So we're estimating it, okay? So that estimate could be less, it could be more, based on the actual closing attorney that you use, as well as some of the other services. But we try to give you as much as a realistic picture as possible so that you're not blindsided of any additional fees that are not disclosed to you. And so if you look at the second part of the slide, which is on your right-hand side, you'll see the total summary of estimated charges for this particular loan is $67,290. And then let's talk about the prepaids and reserves. I mentioned them to you earlier, which is a part of the PITI, which we state hazard insurance, that's your homeowner's insurance. we have to collect a full year of your homeowner's insurance, because as day one, when you close on that house, your house insurance has to be on the house, and we have to pay that 1 year up front. Your other next year's, we'll be collecting that throughout the year of your mortgage payments, okay? And so we estimate about putting 3 months of that in reserves, because of course, homeowners insurance could go up, it could go down. So this year you might have paid $900 annual premium, but next year it might be $1,000, okay? So we try to account for that, so there's not an adjustment. You may hear individuals talk about how their mortgage payment has gone up. Principal and interest, if you're in a 30-year fixed or a fixed rate mortgage, the principal and interest is going to stay the same. What typically is the reason for the up or down is because either your taxes went up or your homeowner's insurance went up. So we normally here at Duke Credit Union try to advise our members to every couple of years keep an inventory or check an inventory on your homeowner's insurance policy, just to make sure that if it's going up, hey, you can always do shopping and you can always change homeowner's insurance. Okay. Property taxes, not much you can do with it unless you feel like your taxes value or your tax value is going up higher than what your actual value of your property is. And you can speak to a lender in determining, at that time, what are the ways that you can sort of dispute that. And so we will do prepays and reserves in regards to that. And here in this example, we estimated roughly $2,800 for that. So on the left side, you see the monthly housing cost, which is your P&I. That's that principal and interest. And then you see your hazard insurance, which is your homeowner's insurance, where we're estimating that, what your property taxes may look like. And then because you only put 3% down, you have that private mortgage insurance. And based off of this amount and this individual, then that estimate was roughly $139. And then on the right-hand side, you'll see purchase price at $250, loan amount at $242,500. Your down payment, which is 3% in this case, is $7,500, and your total charges and prepays is $9,602. And so your total funds to close is $17,102.28. Next couple of slides, I'm going to show you this particular example here was due to an individual who may have had a high credit score. The next slide is someone who has a 650 score. Doesn't mean that we can't do the loan for you, but just keep in mind where credit scores and credit history and all that matters. Because on that previous slide, the payment was roughly $1,700. This, $1,523. On the slide with the 650, your payment is $1,815. So it's almost a $300 difference that you're paying because you're paying at a higher interest rate. And the interest rate on that previous one was 3.25. This interest rate is 3.75 because interest rates are based off of credit scores, debts in relationship to income, the loan in relationship to value, and some other factors as well. And then the next slide, please, is showing what the FHA looks like. The difference with the FHA is not credit score so much. As long as you meet that qualifying criteria, credit score, and credit criteria, whether you have a 650 or a 800 credit score, your interest rate is going to be 2.875 in this example, okay? And the APR is 3.9. The payment here in this case is $1,499, but as you can see, the upfront mortgage insurance by itself was $169, which is roughly about $30 more than the previous slide. And then on the closing costs or the prepays and reserves, you see there's the upfront mortgage insurance. And in this case scenario, you pretty much see that it may add an additional $4,200 to your bottom line of whether or not you're bringing that to closing. Or in some cases, we can factor in that upfront PMI, which will make your payment higher, okay? But I wanted to show just to give you an idea. Again, FHA is a great loan. It's just that it does have these extra MIs because it is a government-backed program. Next slide, please. Well, we've reached the end of our presentation, and I do see that there's some questions that have come in. But again, I just want to thank you for this opportunity to allow Duke University Federal Credit Union to provide this information. And myself and Donna would love to get your questions and answer your questions. And if we're not able to answer all your questions today, because I want to be conscious of your time, please note that you can also send your questions and email us at loan-department@duke.edu. And if you just kind of wanted to take a look at the mortgages that we talked about today in this presentation, please do not hesitate to look at our website at dukefcu.org. And at the very top, you see the fourth option is mortgages. And if you hover your cursor over it, it'll have a drop-down box with mortgage rates and all the other mortgage services that we offer here at Duke Federal Credit Union. So Donna, we're going to turn questions over to you for you to set me up on questions.
Okay, Keisha. So the first question that we have is there any information that you can share about a situation where a owner of a house who is a relative has passed away and you just want to take up payments?
Okay, so good question. If you're wanting to just take up payments and not ownership, you may have to check with the lender who owns the loan. Basically, some loans are assumable loans and some loans are not assumable. And so if it's an assumable loan, meaning other than the person who originally obtained the loan, another person could take over that loan. A non-assumable loan means that that new person would have to get a loan in their name. And so, you know, for example, if it's a parent, you know, that may have passed away and you're the child and you live in the home and you want to take over ownership, just be very upfront with the lender, because at any given point, you know, they could potentially say this loan needs to be paid in full. Either you would need to have to obtain a new loan in your name or have to sell the property. And then of course, you know, you get into other situations such as estate matters and things of that. So you want to be really careful and upfront and touch bases with the lender who's holding that mortgage.
Okay, the next key question, what sort of documentation is required on the application or for the application?
For the application, they want all of your information from your name, your actual legal name, social security, date of birth, want to identify you as being you. And from a lender's perspective, we have to obtain factual information from you. One, to be able to pull an accurate credit report for you. And then two, to be able to make a lending decision in regards to it. So an application, the current application on paper looks like about 4 pages long. Online, it's kind of broken down and walks you through what information is required to put in. So they'll have a little red asterisk beside it. And then you can simply just put in what the red asterisk states. But the hard copy page of application is 4 pages long, and it's asking all of your financials from your income, date of birth, social security, information such as that.
Okay, the next question, for $15,000 housing credit for a first-time home buyer, can those funds be used for closing and or down payment?
Okay, so if you're getting some type of grant or down payment or housing assistance, it's for that purpose, down payment assistance. Our loan programs do allow for that, but you will have to check with that entity who is granting you that $15,000 to make sure that they are okay with us being your lender. I know some loan programs or some down payment assistance programs have preferred lenders that they will allow to use those down payment assistance costs for. As far as closing costs, I'm not 100% because again, it is based off of their guidelines. So if they're saying that's $15,000 for down payment assistance, is to go towards down payment and not closing costs.
Okay, and another question was, is the webinar available for later review? And that response was, we will send all attendees the recording and presentation.
Yes, we will. Yes, we appreciate you being with us today, but we know with the weather and everything else that's going on in life, that you may have missed it, even though you may have signed up for it or you may have come in late. It's okay, because we will send you a copy of the pre-recorded information as well as have it available on our website. It may not be available on our website until next week, Monday, Tuesday. But again, you will also receive any attendees who have accepted to come to the Zoom today will be sent a pre-recorded copy as well.
Okay, and there was one other question, and what I'm going to do with that question is to email that person.
Okay.
Why?
Okay.
And that's it.
That's it. Okay. Well, again, I appreciate anyone for just coming aboard and giving us an opportunity to spend this time with you. Continue to send your questions through the loan-department or DEPT@duke.edu. And Donna or I will be answering your questions. Also, don't hesitate to visit dukefcu.org, of course, because this is mortgages. You can certainly go into the mortgage tab. But from a credit union perspective, we are a full service credit union. So we do have other services that we can assist our members with, including financial guidance, as well as car loans, unsecured lines of loans, credit cards, things of that nature. But if you're looking to purchase, let's keep in mind, maybe talking with Donna and I first, just to make sure that you don't have too many inquiries on your credit. Or whether this is your, first priority to do the mortgage or to build credit. But certainly feel free to reach out to us if you have any questions. All right, well, thank you so much for joining us today. Thanks for this 1 hour. I tried my best to keep you within an hour. And I hope everyone has a wonderful, safe day and week.
Thank you, everyone.